Imagine an artificial intelligence that knows exactly how many margaritas your corporate sales team is going to buy on a Thursday night in Cancun.
Right. Which sounds a bit invasive, honestly.
It totally does, but it uses that exact prediction, right down to the lime, to dynamically price your hotel room months before you even book your flight.
Yeah, and the crazy part is, that isn't science fiction at all.
Exactly. That is the actual literal strategy buried inside the Q2 2026 earnings report for Hyatt Hotels Corporation. So let's unpack this for you today, because usually when we start talking about a corporate earnings report on this deep dive, there is this expectation of, absolute dryness.
Oh, for sure. People think of a spreadsheet. Net revenue, earnings per share, just a cold mathematical ledger.
Right. But then you step into the world of global hospitality, and suddenly that spreadsheet is, it's practically vibrating with human behavior. We are looking at a financial landscape that is honestly a living, breathing map of human psychology.
And geopolitical volatility, too. Plus, massive cultural shifts. The data tells a much larger story than just balance sheets. When you look closely at these specific transcripts, you are essentially looking at the tectonic plates of the global service economy shifting in real time.
And that is our mission for you today. We have a stack of materials centered around the recent Q2 earnings call for Hyatt Hotels, and we are going to decode these numbers.
Because we want to reveal how high-end travelers are actually moving around the globe right now.
Yeah, and how geopolitical events instantly ripple through corporate profit margins, and maybe most importantly, how a traditional physical hospitality brand is quietly, almost invisibly transforming into an asset-light technology platform.
Exactly. We aren't just going to read off spreadsheets today. We're going to figure out the mechanisms behind the numbers. Like, why are these specific metrics moving? What are the mechanical levers management is actually pulling behind the scenes?
So let's start with the big picture, the 30,000-foot view of who is actually packing their bags right now. Before we look at the internal mechanics of Hyatt, we have to look at the external forces driving their top-line revenue. And in the hotel industry, that always starts with the absolute holy grail of metrics, which is RevPAR.
Right. And for anyone outside the hospitality bubble, RevPAR stands for revenue per available room.
So how does that actually work in practice?
Well, it's the ultimate barometer of a hotel's health.
Yeah.
You calculate it simply by multiplying the average daily rate by the occupancy percentage.
Okay, so it combines price and volume.
Exactly. It prevents a hotel manager from artificially inflating their success by, either charging exorbitant rates for empty rooms or giving rooms away for free just to hit full capacity. It's the great equalizer.
That makes total sense. And looking at the headline numbers for Q2, Hyatt's global system-wide RevPAR grew by 5.9%.
Which is huge.
It is. Beating internal expectations and hitting nearly 6% growth in a macroeconomic environment where everyone is basically holding their breath about inflation and consumer spending. That feels like a massive signal of resilient demand.
It definitely is. But it's not a uniform wave, is it? When you break that 5.9% down, the segments are behaving very, very differently.
Yeah, the segmentation is where the real behavioral economics come into play here. Hyatt divides this demand into three main buckets, right? Group, leisure transient, and business transient.
Correct. And in this quarter, group RevPAR increased more than 7%. Leisure transient RevPAR, which is your everyday vacationers, also rose about 7%, and that was heavily led by luxury brands.
Okay, but then there's the third bucket.
Right, business transient RevPAR. That grew by only about 2%.
I look at that 2% growth, and to me, business travel feels like a slow healing injury. It's like a runner who, sprained their ankle 3 years ago. They are walking, they're jogging lightly, but they are absolutely not fully sprinting yet.
Yeah, that's a great way to look at it. Meanwhile, leisure and group travel are out here running ultramarathons at 7% growth.
Exactly.
And that analogy actually holds up perfectly when you look at corporate travel budgets right now. The quick overnight business trip to shake hands with a client, which used to be the bread and butter of that business transient category that was permanently wounded by the mass adoption of video conferencing.
Because corporations just realized they could save millions on T&E.
Right, travel and entertainment. They save all that money without losing the core client relationship. But what replaced that individual travel is the absolute explosion in group travel.
Because companies are more remote now, so they're spending heavily on bringing everyone together just a few times a year.
Exactly. The corporate retreat is essentially the new office water cooler. Because you have a distributed workforce, companies are booking massive offsites, industry conventions, quarterly summits. Group travel isn't just recovering, it's mutating into a much higher yield business for hotel operators.
And the hotels must absolutely love that mutation, right? Because when a company books a retreat, they aren't just paying for 50 rooms. They're paying for the massive ballroom, the AV equipment setup, the catered dinners.
The morning coffee carafes that cost $100 apiece.
Yes, exactly. It creates a completely different revenue base for the property owner compared to just some guy sleeping there before a morning meeting.
It's called ancillary spend, and it is by far the highest margin revenue a hotel can generate. Furthermore, the visibility on group travel is incredible for a management team.
What do you mean by visibility? Like they can see it coming?
Yeah, exactly. Hyatt noted in this call that they already have 96 to 97% of their expected group revenue for the entire year already on the books.
Wow, that's locked in.
They're even pacing perfectly for next year. It gives them a financial floor that standard leisure travel just cannot provide.
But we have to talk about the absolute wild card in this quarter's numbers. The thing that supercharged these metrics, especially in the United States, is what I'm calling the FIFA effect.
Oh, the FIFA World Cup impact. That is a fascinating case study in localized economic stimulus.
It's mind-blowing. So in the United States, overall, RevPAR grew a very strong 6.7%. But the chief financial officer, Joan Bottarini, she specifically noted that the FIFA World Cup contributed a massive 70 basis points to that total U.S. growth.
Which is wild when you think about the scale of their U.S. portfolio.
Right. Out of that total 6.7% growth across the entire domestic footprint, nearly a full percentage point was driven solely by people traveling for a soccer tournament.
To understand the mechanics of that, you really have to look at how hotel revenue managers handle a demand shock. When a tournament like this comes to a host city, it causes what the industry calls compression.
Meaning there are suddenly way more people who want a bed than there are actual beds in the city.
Yes. And that allows the revenue management algorithms to just push the average daily rate through the ceiling. They yield out the lower paying customers entirely.
Wait, so they just block them out?
Basically. If you were planning a quiet weekend getaway to one of those host cities during June, the pricing algorithm recognized the incoming FIFA demand and priced you out of the market months in advance.
And the numbers back that up in a ridiculous way. When you zoom in on just the specific cities hosting those matches in June, group RevPAR was up over 13%, and leisure transient RevPAR in those host cities was up an astonishing 17%.
It's a perfect storm for a hotel operator. What's fascinating here is how a single global cultural event entirely alters a quarter's trajectory. It acts as a localized economic stimulus package that just funnels capital directly into the hospitality sector.
But you know, it also highlights something a bit fragile about these quarterly earnings reports. If a massive chunk of your domestic outperformance is tied to a one-off sporting event, aren't you setting yourself up for a terrible headline next year?
Oh, absolutely.
Because next Q2, Hyatt will have to lap this quarter. They have to compare their 2027 numbers against these hyperinflated 2026 FIFA numbers. It's going to look like domestic demand is collapsing, even if the underlying business is perfectly healthy.
That is the perpetual hazard of year-over-year comparisons on Wall Street. The algorithms often lack the nuance to parse out a one-time event from a structural decline. And frankly, this is precisely why Hyatt has been so laser-focused on the high-end premium traveler.
Oh, to sort of build a buffer.
Exactly. They're trying to build a baseline of demand that isn't reliant on a singular event.
Because the premium traveler is less sensitive to inflation or economic wobbles, CEO Mark Hoplamazian made a point to emphasize that for 8 quarters running, luxuries has had the highest RevPAR growth and the highest rate growth in every single region around the world.
The upper-tier consumer is effectively subsidizing the broader industry right now. Their balance sheets are largely insulated from the day-to-day inflationary pressures that might cause a mid-tier consumer to cancel a summer vacation.
Right. So we've seen how a soccer tournament can inject millions of dollars into the U.S. market, acting almost like a lottery win for those host cities. But what happens when the external forces acting on a company aren't so festive? Let's pan the camera out to the rest of the global map, because this quarter reveals a tale of massive triumphs juxtaposed against some really stark geopolitical realities.
Well, a global hotel brand is inextricably linked to the geography it occupies. You can't just pack up a 400-room resort and move it if a region becomes politically or economically unstable.
Very true. But let's start with the triumph, which is honestly a bit counterintuitive if you regularly consume general financial news. We need to talk about China.
Right, the China narrative.
The dominant narrative in the broader financial press right now is heavily focused on China's macroeconomic concerns, right? The slow motion crisis in their real estate sector, youth unemployment, overall sluggish consumer spending. But then you look at Hyatt's numbers, and Greater China RevPAR increased 7.2%.
And the underlying details of that 7.2% are even more striking. Hoplamazian stated that China luxury properties were up 11% this past quarter.
11%.
Yes, that is explosive, double-digit growth in a market that many global analysts currently view with extreme caution.
I look at that and wonder how it's structurally possible. Like, how is the high-end Chinese consumer still spending so aggressively on luxury travel while the broader macroeconomic indicators for the country are flashing warning signs?
It comes back to the bifurcation of the consumer we talked about earlier, but amplified to an extreme degree in the Chinese market. The upper-tier luxury consumer in China is still highly capitalized. They have accrued massive savings, and they're highly motivated to spend on premium experiences rather than hard goods.
Okay, so it's domestic demand.
Mostly, yes. What we're seeing in the data is that domestic leisure demand, meaning Chinese citizens traveling within China for high-end vacations, is driving the bulk of this property-level growth.
But there is a second layer to this success story, which is the inbound international traveler, right?
Exactly. After a prolonged, highly restrictive post-pandemic period, international travelers are finally crossing a border back into China in meaningful numbers.
Yeah, Hyatt reported that inbound travel from the U.S. was up 18% this past quarter, and inbound from Europe was up a staggering 24%.
They mentioned that their inbound mix is currently sitting around 24% of total guests in the region, compared to about 30% pre-COVID.
So they still have a significant runway of growth just to get back to their historical steady-state baseline. But an 11% jump in China luxury really validates the thesis that if you cater exclusively to the top tier, you can essentially build a fortress around your balance sheet, regardless of broader economic turbulence.
A fortress, perhaps, but no company is entirely immune to the physical realities of the globe. And that brings us to the severe headwinds Hyatt faced this quarter.
Yeah, this is where the map gets complicated and a bit sobering. We have two major regions that acted as a massive drag on the company's earnings: the Middle East and Mexico. Let's start with the Middle East. It is a stark reminder of the human and geopolitical realities of the world. RevPAR in the Middle East plummeted by 36% due to the ongoing regional conflict.
A 36% drop in a single quarter is a devastating demand shock.
And from a purely financial perspective, the CFO estimated that this regional conflict is going to reduce their full-year fees by approximately $10 million. There is nothing a local hotel manager or a brilliant marketing team can do about that. You cannot outmarket a war.
No, you can't. And the mechanics of that $10 million loss are important to understand. Because Hyatt operates largely on a franchise and management fee model, that $10 million isn't just lost top-line revenue, it is lost high-margin fee revenue.
Meaning it hurts more.
Much more. It flows almost directly to the bottom line, which makes the impact sting even more.
But then you couple that geopolitical shock with what happened in Mexico, which was a very different kind of headwind. Let's look at the net package RevPAR for their all-inclusive portfolio in the Americas, which declined 1.2%. Now, really quickly, we defined standard RevPAR earlier, but what exactly is the mechanic behind net package RevPAR?
Good question. It is a financial metric specific to the all-inclusive resort business model. In a traditional hotel, the revenue streams are siloed. You pay for the room, that goes to room revenue. You pay for dinner, that goes to food and beverage.
Right.
But in an all-inclusive, you pay one lump sum up front for the entire experience. So net package RevPAR measures the total revenue from that comprehensive guest package minus certain direct costs divided by the available rooms. It's a holistic look at the total value extracted from every guest on the property.
Got it. Okay, so that number dipped 1.2%. And management traced this decline back to a combination of lower flight capacity into the region and a specific security incident that occurred in Cancun earlier in the year. Now, that incident happened way back in February, but the psychological hangover for travelers booking their summer vacations meant that Q2 demand suffered.
Leisure travel is a highly emotional, discretionary purchase. The moment a destination is perceived as unsafe or even just logistically difficult to get to because airlines have cut back on direct routes, the leisure traveler simply pivots.
They just go somewhere else.
Exactly. They don't cancel their vacation, they just change the destination.
And that pivot cost Hyatt dearly in the region. They projected a $15 million reduction in their full-year fee outlook, specifically because booking trends in Mexico, while improving sequentially week over week, just haven't recovered to the extent they initially modeled in their internal forecasts.
So when you combine the Middle East and Mexico, you are looking at a $25 million hit to anticipated fees wiped off the board due to external regional events.
Which brings up a glaring contradiction in this earnings report. I mean, how does a company absorb a combined $25 million hit, announce it publicly on the call, and in the exact same breath, turn around and actually raise their full-year RevPAR guidance to 3.5 to 4.5%? It feels like financial cognitive dissonance.
It sounds like it, but it's actually a textbook demonstration of the power of a globally diversified real estate portfolio.
Okay, how so?
When you have hundreds of properties across dozens of countries, regional volatility is somewhat neutralized by the sheer scale of the network. Yes, they lost demand in Mexico. But as we noted, those affluent travelers didn't just stay home and put their money in a savings account, they redirected their vacation spend.
So where did all that displaced money actually go?
A significant portion of it flowed directly into the Dominican Republic. Hyatt reported that net package RevPAR in the Dominican Republic increased over 8% in the second quarter.
Oh, wow. So they just moved islands.
Basically, people who might have traditionally gone to Cancun diverted their dollars to Punta Cana. Furthermore, the CFO noted that early 2027 booking pace for the Dominican Republic is up a massive 20%. The demand wasn't destroyed, it was merely geographically displaced.
And because Hyatt has built up a massive portfolio of luxury, all-inclusive properties in both places, they still catch the money. It's like having a giant net covering the entire ocean instead of just dropping one fishing line off the pier in Cancun.
That structural diversification is exactly what gives management the confidence to absorb a $25 million localized hit and still tell Wall Street, we are actually going to generate more system-wide revenue globally this year than we previously modeled.
It makes perfect sense when you look at the map. But if Hyatt is shifting the physical locations where they are making money, they are also fundamentally changing how they make money. And this is where we have to dive into the most transformative part of this entire earnings call. Because Hyatt is no longer just a landlord.
Right. We are witnessing the maturation of their asset-light transformation, which is the core engine of their entire corporate strategy right now.
Let's transition into the mechanics of this, because this is where the traditional century-old hotel business model gets completely turned on its head. For decades, if you were a hotel company, the playbook was simple, but brutally heavy.
Very heavy.
You bought a prime piece of real estate, you poured concrete, you built a massive structure, and you hoped enough people slept in the beds to pay off the mortgage and cover the maintenance. It was a capital-intensive real estate business that just happened to serve breakfast.
It was a business of owning the bricks and the beds. But physical real estate is inherently risky, and it's cyclical. It ties up billions of dollars in capital, it requires constant, expensive physical maintenance, and in an economic downturn, you are left holding the bag on massive fixed costs while your revenue plummets.
So Hyatt is systematically shedding the bricks. They are actively transitioning away from owning real estate to a fee-based franchise and management model. They've been selling off their own hotels, though they did note in this call that the planned sale of the massive Hyatt Grand Central in New York has been pushed past 2026 due to some development complexities.
But the overarching strategy remains completely intact.
Exactly. They want to manage the brand, they do not want to own the building.
To understand why this pivot is so incredibly lucrative for shareholders, we have to look at the digital moat they are building to replace that physical real estate. If you no longer own the building, what is your actual product? Your product is your network. Your product is your loyalty program.
Okay, here's where it gets really interesting. Let's talk about the World of Hyatt loyalty program. They reported 69 million members. That is a 17% year-over-year growth, 69 million people. To me, this is the ultimate digital flywheel.
A flywheel? How do you mean?
Well, every time Hyatt opens a new hotel in a new city, the loyalty program becomes marginally more valuable to you, the guest, because you have more places to earn and redeem your points.
Right. And crucially, the reverse is true for the developers. Every time Hyatt adds a new member to that 69 million strong database, the brand becomes infinitely more attractive to a real estate owner.
Oh, because of the built-in audience?
Exactly. If I am an independent developer building a $50 million luxury resort, I want to fly the Hyatt flag because it instantly plugs my empty building into a pipeline of 69 million highly engaged, affluent travelers. It lowers my customer acquisition cost by marketing spend to find guests to almost zero.
They also mentioned a new collaboration with Air Canada to link their loyalty programs. It's all about increasing the stickiness of the network. If I can earn flight upgrades on my preferred airline just by sleeping in a Hyatt, my switching costs become too high. I'm never booking a Marriott or an independent boutique hotel again. It locks the consumer into a closed ecosystem.
If we connect this to the bigger picture, this network effect is the alchemy of the asset-light model. By leveraging this massive loyalty base, Hyatt generates what they call gross fees. In Q2, their gross fees hit $324 million, representing an 8% increase year over year.
Let's break down the mechanics of a gross fee.
Yeah.
Because it's essentially a tax on the hotel owner, right?
In a way, yes. When an independent owner signs a franchise agreement with Hyatt, they agree to pay a complex structure of fees. They pay a percentage of their gross room revenue. They often pay a percentage of their food and beverage revenue. They pay marketing fees and they pay licensing fees just to use the name and the central booking system.
Wow.
Yeah, Hyatt collects all of this money off the top line simply for providing the brand standards and the software infrastructure.
So it's literally like the Apple App Store model. Hyatt is becoming the iOS of the hotel world. They don't want to build the physical phone, the hotel. They just want to charge the developers a 30% tax for being allowed to operate on their operating system.
That's a very apt comparison.
And generating $1 of fee revenue requires almost zero capital compared to generating $1 by physically building and operating a hotel.
The margins on fee revenue are astronomical compared to real estate operations. And that is why their adjusted free cash flow is exploding. They projected their adjusted free cash flow for the year to jump 20 to 30%, landing somewhere between $580 million and $630 million.
That is a lot of cash.
They are converting at least 50% of their adjusted EBITDA directly into free cash flow. That is liquid cash they can use to buy back stock, pay dividends, or invest in new technology without having to worry about replacing a roof on a 400-room building.
But wait, if they are making all this high-margin cash by acting like a software and brand licensing company, they are now directly competing with Hilton, Marriott, and IHG, not just for the guests sleeping in the beds, but for the actual billionaire real estate developers deciding which flag to fly.
Right, because everyone wants those asset-light fees.
Exactly. If Hyatt doesn't own the buildings, their product isn't a hotel room anymore. Their product is their technology and their management prowess.
And that is the pivotal battleground in an asset-light world. How do you convince a real estate developer in Dubai or Miami to choose Hyatt over a competitor? You have to prove to them mathematically that you can generate a higher return on invested capital for their building.
You prove that flying your flag lowers their operational overhead and increases their profit margins. And Hyatt just dropped a massive, highly technical statistic on this call regarding exactly that. They detailed a multi-year investment in a brand new cloud-based technology platform.
Yeah, the Opera Cloud rollout.
Right. They rolled out Opera Cloud, a new central reservation system, and a new revenue management system all within the last 18 months. And the result of migrating to this modern architecture, a 40% reduction in property management system costs for their owners.
A 40% reduction in a core operational expense is staggering for a hotel P&L.
What exactly is a property management system doing for a hotel, like day-to-day?
A property management system, or PMS, is the central nervous system of a hotel property. It handles check-ins, guest billing, housekeeping schedules, room assignments, literally everything. Historically, these were clunky on-premise servers sitting in a back office. They required dedicated IT staff, constant physical maintenance, and exorbitant recurring licensing fees.
So taking it to the cloud just strips all that weight away.
Exactly. By moving this entire architecture to the cloud, Hyatt fundamentally altered the cost structure for their franchisees.
I noticed Hoplamazian even pointed out that they eliminated IT implementation fees for all new hotel openings. He said, "These were not bills that were sent out to owners to pay for the systems. We paid for that." Now, my immediate thought reading that was, aren't they just subsidizing the owners? Doesn't eating those implementation costs hurt Hyatt's bottom line?
It's a strategic loss leader. Hyatt spends their own corporate capital up front to build a superior, cheaper tech stack, knowing full well that it will act as a massive magnet for new developers.
Kind of a necessary evil to get them in the door.
Exactly. When a developer sits down with their financial analysts and compares the franchise disclosure documents across the big hotel brands, they model out the 10-year operating costs. That 40% cost reduction on the PMS line item, combined with zero upfront implementation fees, is a glaring neon sign pointing toward Hyatt. It shifts the math in Hyatt's favor to win the franchise contract.
Lowering costs is a great pitch, but it's only half the battle. You also have to drive revenue for the owner. And this is where I kind of lost my mind reading this transcript, because we have to talk about how they are deploying artificial intelligence at the front desk.
The integration of proprietary AI into their revenue optimization strategy is a genuine paradigm shift for the industry.
We brought it up at the very beginning of the deep dive, but let's actually dive into the mechanics of it. Hoplamazian noted that they have developed a large-scale AI platform to actually score and value every single piece of group business that comes through the door. I want you to really picture what this means on a practical level.
To understand why this is revolutionary, you have to understand the legacy model of how group business has traditionally been booked.
Which is mostly just people on the phone, right?
Pretty much.
Yeah.
Usually, a corporate meeting planner calls a hotel sales department and says, "I need 50 rooms for a retreat next October. What kind of discount can you give me?" A human sales manager looks at a calendar, sees that October is looking a bit slow, and offers a 20% discount just to secure the revenue and get heads in beds.
But that human sales manager is operating on limited, siloed information. They might not be factoring in the total ecosystem of that specific booking.
What the AI does is analyze thousands of variables instantly to execute what we call total revenue management. It looks at historical data across the entire Hyatt network, local event calendars, flight capacities, and most importantly, anticipated ancillary spending profiles.
Oh, like the margaritas.
Yes. The AI might look at that request for 50 rooms and realize, based on historical data, that this specific corporate client spends an exorbitant amount of money at the lobby bar and books out all the premium spa appointments.
So the AI steps in and tells the sales manager, give them a 30% discount on the room rate. It looks like a loss on the rooms, but we will make it all back and then some on the margaritas and the massages.
Or, conversely, the AI might recognize that a different corporate group historically negotiates fiercely on room rates, but never spends a single dime on food and beverage because they eat all their meals off-site. The AI will flag that inquiry and tell the sales manager, do not discount these rooms. It is a bad total revenue deal. Hold out for a better group.
Yeah.
It mathematically balances group room discounts with anticipated total property spending to optimize the total margin of the hotel.
It's Moneyball for hotel banquets. It completely removes the human guesswork and the emotional desperation from pricing strategy. And because they are rolling this AI tool out across their managed portfolio, they are seeing, in their own words, really healthy flow-throughs, meaning a much higher percentage of top-line revenue is actually flowing all the way through the income statement to become bottom-line profit.
And once again, put yourself in the shoes of an independent hotel owner. If Hyatt comes to you and says, we have a proprietary AI engine that will mathematically guarantee you extract the absolute maximum profit margin from your ballroom and your spa, you are going to sign that franchise agreement.
Right. But wait, if they have this incredible tech stack and the AI is optimizing margins and the loyalty program is driving down customer acquisition costs, why are they still facing bottlenecks and opening new hotels?
The physical pipeline.
Exactly. Which brings us to the actual physical growth of the brand footprint. We have seen the demand, we've broken down the financial strategy, and we've marveled at the tech engine. But how does all of that translate into actual physical new hotels opening their doors?
It translates into a record-breaking development pipeline, but not without significant growing pains.
The raw numbers here are massive. Hyatt ended the quarter with a record development pipeline of 154,000 rooms. That is up 10% from last year. And in the second quarter alone, their net rooms growth was 4.4%.
A really vital context point that CEO Mark Hoplamazian stressed during the Q&A portion of the call was looking at the two-year stack.
I'm glad he brought that up because looking at just one quarter of real estate development can be incredibly noisy. Hotels get delayed by weather, permits get held up, or properties leave the system.
He pointed out that if you look at the net rooms growth from the first half of 2024 through to the first half of 2026, the two-year stack growth is an incredible 16%. That proves the momentum isn't a statistical fluke, it's a sustained compounding expansion of their footprint.
They are targeting approximately 6% net rooms growth for the full year, but they openly discussed a major bottleneck, and I want to push back on their strategy here. They noted that over 50% of their expected openings for the entire year are scheduled for the fourth quarter, just jammed into the last 3 months of the year.
It is a massive, risky concentration of openings, and management openly admitted that some of those openings will likely slip into the first quarter of 2027.
And the reason why is what caught my eye. It's not just standard construction delays or supply chain issues with drywall. Over 60% of these Q4 openings are in their luxury, lifestyle, and full-service categories. Hopelmazium pointed out the immense complexity of certifying these high-end properties. There are so many exacting brand standards that have to be prepped and certified before they will let a property open its doors. And this ties directly into something called a PIP, or a Property Improvement Plan.
PIPs are the absolute friction point of the franchise model.
Uh-huh.
When an existing hotel, let's say an aging independent property in Chicago, wants to convert and join the Hyatt system under their new Hyatt Select or unscripted conversion brands, Hyatt doesn't just slap a sign on the door and turn on the booking engine. They issue a property improvement plan.
Right, and I was reading about the mechanics of these PIPs, and my first thought was, isn't this a terrible business move? A PIP is a mandatory, exhaustive list of renovations the owner must complete. It might mean ripping out all the flooring, upgrading the HVAC system, entirely redesigning the lobby flow, or overhauling the Wi-Fi infrastructure.
It can easily run into the millions of dollars.
Exactly. Why put up so much red tape and demand millions in renovations from an owner? Doesn't that actively throttle your own pipeline and delay your fee revenue?
It looks counterproductive on a quarterly earnings sheet, absolutely. It creates friction and delays. But long-term, it is arguably the most important strategic decision they make to protect their digital moat. If you compromise your brand standards just to hit a quarterly net room growth target, you dilute the brand equity.
Because if a guest uses their hard-earned World of Hyatt points to stay at a converted hotel, and the HVAC is rattling and the carpet is threadbare, they have a terrible experience, and they lose faith in the entire Hyatt flag.
Precisely the danger. By holding firm on the PIP requirements, even if it frustrates the owner and delays the opening by 6 months, Hyatt ensures that when that hotel finally does open, it can command a premium luxury rate. As Hopelmazium articulated on the call, what you end up with is a higher quality, higher rated, more profitable hotel coming out the other end. It is short-term friction for long-term rate power.
I love that tension between rapid growth and brand protection. Protect the brand at all costs, because the brand prestige is the only thing generating those asset-light fees. But there is another massive roadblock to getting these hotels open, even if the owner agrees to the PIP, and it's the oldest problem in commercial real estate: money.
Capital markets are incredibly tight right now, especially for commercial real estate. Interest rates remain elevated, and regional banks, which typically fund the bulk of mid-scale hotel construction, are being extremely conservative with their lending portfolios.
You can have 154,000 rooms signed in your pipeline, but if the developers can't get a bank loan to buy the concrete and pay the electricians, those rooms are just imaginary numbers on a spreadsheet.
So how is Hyatt solving this? They are a hotel brand, not a bank.
They aren't a bank, but they are deploying their corporate balance sheet to act like a mezzanine lender to grease the wheels of development. They announced a $500 million financing facility established with Hall Structured Finance.
Walk me through the mechanics of that. How does Hyatt getting involved to help a developer in Texas build a hotel? This facility specifically targets developers who have signed deals to build properties under the new Hyatt Studios brand. Hyatt is essentially stepping in and providing credit support. They are guaranteeing a tranche of the debt, which significantly lowers the risk profile for the primary lender, in this case, Hall Structured Finance.
Oh, so they co-sign, basically.
Effectively, yes. Because Hyatt is putting its own pristine corporate credit rating behind the project, the developer can secure the construction loans they need to get shovels in the ground.
It is a brilliant, proactive way to unblock their own pipeline. They aren't just crossing their fingers and hoping the macroeconomic environment improves. They are actively engineering financial solutions to remove the primary friction point preventing their growth.
And they're doing something structurally similar, but entirely adapted to local market mechanics on the other side of the world. They announced a master franchise agreement with the Dossen Group to expand the Hyatt Select brand in mainland China.
But this isn't about new construction or credit support. This is about adaptive reuse. What does commercial real estate development actually look like in the Chinese market right now?
In the upper mid-scale segment in China, the business model is fundamentally different than in the West. Developers aren't typically buying empty plots of land and building a hotel from scratch. The market is saturated with underutilized commercial real estate.
Empty office buildings and such.
Yes, exactly. So developers are leasing existing office buildings and adaptively redeveloping the interiors into hotels.
Which sounds like a logistical nightmare.
It requires a very specific, deeply ingrained local infrastructure to execute these massive commercial lease deals, navigate local zoning, and manage the adaptive renovations. Hyatt, as a global corporate entity based in Chicago, recognized that they do not have the internal apparatus or the local relationships to efficiently run around China, signing 10-year commercial leases on half-empty office buildings.
So they partnered with Dossen, who is an absolute powerhouse at exactly this type of localized development. Dossen has the boots on the ground, the local market expertise, and the development capabilities. Hyatt provides the global brand prestige and the mathematical engine of the World of Hyatt loyalty program.
It is a perfect symbiotic relationship. It allows Hyatt to scale rapidly into white space markets in Asia without taking on the cumbersome capital-heavy real estate leases themselves, perfectly maintaining their asset-light philosophy while accelerating growth.
Between the $500 million financing facility in the U.S. and the Dossen Master Franchise Agreement in China, you see a management team that refuses to passively wait for their pipeline to materialize. They are actively engineering bespoke solutions to overcome localized logistics and financing hurdles.
It demonstrates a highly sophisticated, multi-pronged approach to growth that relies on financial engineering just as much as hospitality management.
So what does this all mean for you? We have spent the last hour dissecting a single corporate earnings call, but we've essentially mapped out the entire blueprint of the modern service economy. We've seen how global travel is bifurcating, with luxury and leisure absolutely sprinting ahead while traditional business travel jogs behind, forever altered by the digital workspace.
Yeah, and we've seen how geopolitical conflicts in the Middle East and localized security concerns in Mexico act as an immediate, unavoidable tax on regional revenue.
And yet, we've seen how a globally diversified portfolio acts as a shock absorber, catching displaced demand in places like the Dominican Republic to maintain overall corporate guidance.
Furthermore, we have explored the profound hidden mechanics of the asset-light transformation. We've seen how a 69 million member loyalty program acts as an impenetrable digital moat, lowering customer acquisition costs to the point where developers are practically begging to join the system.
We've seen how leveraging cloud computing and proprietary AI allows a legacy brand to slash operational costs, optimize profit margins, and mathematically guarantee higher yields for their franchise owners.
It is truly remarkable. Whether you are an investor trying to understand the nuances of corporate strategy, a traveler wondering why your hotel room rate fluctuates so wildly during a soccer tournament, or a business student studying the power of network effects and platform economics, the insights buried in these numbers are profound.
It fundamentally changes how you view the physical infrastructure of the world around you. The next time you walk into a beautifully designed hotel lobby, you aren't just looking at a building.
No, you're standing inside a physical node of a massive AI-optimized asset-light technology network.
Which leaves me with a final, lingering question to throw your way. Something for you to mull over the next time you are booking a trip. We have just watched a massive legacy hospitality company systematically shed almost all of its physical real estate. They're outsourcing the actual construction and ownership of the buildings to independent developers. They are relying on third-party financing vehicles to get them built. And they are using artificial intelligence algorithms to manage the pricing and optimize the margins on the margaritas in the lobby bar.
That's a total transformation.
So if they don't own the buildings and computers are managing the rates, are they still fundamentally a hotel company, or have they actually just become a massive software, data, and brand licensing firm that just happens to provide you with a place to sleep? We will leave you to think on that. Until next time, keep looking past the spreadsheet.